Hello, this is the first of a series of discussions we're going to have on capital budgeting. So this is the introduction to capital budgeting, explaining what capital budgeting is, and then the first step in the capital budgeting process is to estimate cash flows, and so we'll be going through that as well in this presentation. So what is capital budgeting exactly? Capital budgeting is probably better known as cost-benefit analysis. I like to call it strategy in action. Basically, as firms decide where they want to move strategically, then you choose projects that help support those strategic initiatives, and you have to analyze those projects. And so the analysis of those projects is what we refer to as capital budgeting. And firm approval, or project approval, I should say, actually varies from firm to firm. Let's talk about that just a little bit. First of all, how do we allocate capital? Firms work with a fixed capital budget. And so that puts them in a position where they're forced to rank projects from most important to least important, and also keeping in mind those projects that add the most value to the firm versus those that add the least value to the firm. And so some firms will require that the project approval process goes through this very centralized channel of checks and balances. Hershey's Corporation is a very good example of that. I had the great pleasure of attending a panel discussion a few years ago in New York City, where we had the CEO or the CFOs of Hershey, Johnson & Johnson, Southwest Airlines, Macy's, not Macy's, Saks, and a couple other companies that are less well known, and they were talking about their capital budgeting processes. And Hershey's was extremely centralized, where all capital budgeting projects had to go through this one channel of approval processes, and had to be approved, at these various checkpoints all the way up to the top. The complete opposite was Johnson & Johnson. Johnson & Johnson had a very decentralized process where each of their business units or divisions, they called them divisions, they each had their own budget, and the vice president of each of those divisions basically had the power to, approve or not approve the projects. Exceptions to that, of course, might be if it's an extremely large project, something like buying out another company. Without a doubt, those have to go through a more centralized process and actually generally have to go to the board of directors, regardless of what firm you work for. But the allocation process basically, varies quite a bit. So I gave you two extremes, and most firms fall in the middle there. Project ideas, they can come from the top down or from the bottom up. So in other words, from the bottom up, your workers on the floor can be the ones that come up with project ideas and present them to the manager. A proposal can be put together, and then therefore that manager tries to get that proposal approved. Or it could be a situation where the president, perhaps of the corporation, CEO, comes up with a project idea, and generally when they come up with the project idea, it's a done deal. And so hopefully they've already gone through the numbers and found that it's going to add value to the firm. And then as they push those numbers downward, it's more of a marketing effect at that point, where they're trying to show others that this is something that's going to add value to the firm. But it's already hopefully been completed at the top. In most cases it has. As I mentioned before, projects should support the most important strategic objectives of the firm. I mean, that should be a given. And something that's extremely important, and not all firms do this, this is the most neglected part of capital budgeting, and that is establishing some sort of accountability. Accountability in terms of how good were your estimates versus your actual outcomes. And that will help you improve your processes in the future. You don't have to use it as a hammer, to hammer people over the head if they're wrong in their predictions, because sometimes there's forces that are just completely out of your control and there's nothing you can do about it. Other times it could be that rosier numbers were predicted or forecasted because this individual really wanted to get this project through. So, having that accountability there, I think, is important so that managers try to be as honest and truthful as they can about, what will realistically come from this project. This particular slide you should take a picture of, take a snapshot, mark. This is basically what you will be doing in your capital budgeting project analysis. You're going to be bringing your own project in, as we talked about in class, and this is what you're going to be doing as a group for the project. So you will first collect your revenue and your cost data, and then you'll use that to estimate your cash flows, as you see there in step 3. You're also going to identify your risk factors. So in other words, obviously when you estimate your cash flows, you know that some things may not possibly turn out as well as you expect. And so what are those things that you're worried about? What are those factors that could possibly be different than what you expect? Generally the level of sales you expect could vary. It could be your expenses could vary. If it's an international project, it could be your export prices could vary. It could be currency issues, currency translation. There's all sorts. There could be even political risk. So there's all sorts of different risk factors that are very specific or unique to a particular project, and so you want to consider that in the analysis and conduct research, because we're going to have to work that risk into the analysis to get something that's really worthwhile for the company to use. And so we'll take all this information, we'll develop not only one set of cash flows. For purposes of this chapter, we're going to come up with what we call our original point estimate. So we're going to make our best guesstimate of what we expect our cash flows to be. And then later when we incorporate risk, we'll come up with other cash flow alternatives. Then we will evaluate those cash flows, which is the next discussion that we'll have in class, and that is where we will compute the net present value, the internal rate of return, the modified internal rate of return, the payback, the profitability index, and you can do some others as well, but those are really the 5 biggies that we'll be talking about and will be required for the project. Then you will conduct a complete risk analysis of the project, and that's another lecture down the road. And then I always talk about considering soft issues. A lot of times with projects, there are issues that are extremely important to the project, but you can't quantify it because it's just not quantifiable. For instance, the benefit of maybe putting an on-site daycare center might be to attract more female employees. That's a particular project that happened years ago for a firm. They were doing the numbers, evaluating whether or not they should have this on-site daycare, because their goal was they wanted to try to attract more females to the workforce there. So while you could quantify maybe, the benefits of having that child care center would be perhaps less absenteeism, that's quantifiable, but bringing more women into the workplace, that one isn't. But that is actually what drove the decision on that project. So soft issues can be extremely important and should be discussed if you have any soft issues associated with the project, and almost all projects do have that. And then finally, you want to make your recommendations and your conclusions. So this is a great slide to refer to, well, and also your notes and your syllabus goes through, step by step what you need to do for your project. Now, there are traditional types of outlays that are listed here, and they go from easy to evaluate down to extremely difficult to evaluate. My suggestion is to bring in a project that's as difficult as possible. This is an opportunity to, work through something that could actually really benefit you in the workplace. But basically, just to run through these quickly, you've got safety or environmental outlays. Those are projects that have to be done because either you're looking to provide a safer product for your customers, or something that's safer for your employees, or the Environmental Protection Agency has said that you've got to do this. And so you want to complete the project at the lowest possible cost. And that's the goal there. And so there isn't a whole lot in terms of analysis. The second one, kind of the same way in terms of there's not a whole lot in the way of analysis. Replacing a current asset, you're really not having to make any real big cash flow projections. Some, but not a lot. I mean, you're already in the market, you know what the demand is, you know what your costs are. It's very possible that maybe this asset that you have is obsolete. Now they have more efficient equipment out there, better equipment, improved equipment. So you're trying to determine, okay, well, maybe the cost savings of, it would be the quantifiable benefit of replacing the asset, or maybe if you get better results as a result of buying this asset, you could increase your prices, so you'd have a slight revenue increase that would make the replacement of this asset something positive for the firm. So those are generally pretty easy to estimate. Now when you get into the third category, now we have more risk involved, because here you're looking at investments to increase capacity in an existing line of business. Whenever you have an increase in capacity issue, then that involves more forecasting, right? And more forecasting you have, the more possibility of errors. And so here, there is more risk involved, because while you can, given it's an existing line of business and something you're already familiar with, still you can be off on your projections. And maybe while you thought this investment to increase capacity was a good idea, it may have turned out not to be the case. And I did have a project in one class with an individual that manufactured specialized t-shirts, and he had so much business he had to turn it away. He couldn't get it all done, so he analyzed, or his group analyzed, whether or not he should add a second shift. And it turned out that when he did the research and looked at the demand that he had turned away, and then figured, okay, he'd get a little extra demand on top of that, was it worth it to bring on the second shift of people to make the t-shirts? And the answer turned out to be no. So he stuck with one shift. So it's all, you have to analyze it to see if it's worth the investment. And then the most difficult one is when you're looking at an investment in new product lines or services, or just brand new ventures in general, because this is a line of business usually that you don't have any experience with. So, it could be breaking into a new geographical area. It could be just coming out with a whole new product. Anything that's just that you don't have any experience with. And those are the highest risk projects, because you really are depending on your research to try to come up with your best estimates, and there's probably going to be quite a bit of variation from your actual results versus what you originally estimate, just because it's something that your firm isn't in the business of doing yet, at least. But it can be evaluated, and those are actually the most interesting projects to evaluate. So if anyone has something like that they can bring to the table, that would be awesome. I do want to point out that when we talk about capital budgeting, it doesn't necessarily have to be used to evaluate, physical hard assets. You can use these same processes to determine whether you should invest money in the advertising campaign, whether you should invest more money in research and development, whether you should invest money in employee education and training. Oftentimes it's hard to quantify the return on that. That oftentimes is a soft benefit, but it can't, it has been done and can be done. Other examples, this one is pretty easy to evaluate, whether you refund an old bond issue and go with a newer, lower interest issue. That kind of seems like a no-brainer, but sometimes not necessarily. There's some, and we can talk about some examples of that later on. And then investments maybe in permanent increases of inventory levels or accounts receivables. Do you want to increase your credit terms to try to draw in more business, but it means you're going to have more money tied up in receivables? Is it worth that? That's actually another type of capital budgeting decision. So basically, anytime you're making an expenditure from the capital budget, whether it's a hard asset or not, it could be whether or not you add another person to your staff. It can go through this capital budgeting process. It's just that the only difference is when you're looking at some of these other issues, you don't have depreciation. But other than that, and we'll work through an example, in class at some point where we don't have depreciation in the example. Okay, applications of capital budgeting analysis. Another thing that's kind of interesting is, obviously the most obvious one is the first one there, and that's when you're just trying to determine, is this a project that adds value to the firm? But also you can use it to solve business problems. So project evaluation techniques are used to determine best alternatives. So you can maybe be looking across a bunch of different alternatives on how to solve the same problem, or how to meet the strategic objective, and capital budgeting will help you determine the best path. We have used capital valuations to solve company problems. Oftentimes we might have a project where it's actually helpful to the company to do a capital budgeting analysis, maybe from the customer's perspective. And if you do a capital budgeting analysis from the customer's perspective, then it might help you see why your customers are not choosing you as the source of their product or service. Or it could be, if it turns out well for the customer when you do the analysis, it could be used in sales to show customers why it's best that they go with you. I've had this has actually been used a whole lot in capital budgeting, in various examples I've done in classes. And there's times where you can really see the value to the customer if they purchase their product through you, and so it becomes part of their sales pitch. Other times it's like an eye-opener as to, wow, okay, if we look at what we do for the money versus what a competitor is doing for them for the money, we need to either adjust our services or adjust our prices so that we're more in line and can compete more effectively. So that's a great way to use capital budgeting to kind of solve some problems, and as I mentioned, it can be used to support sales. The characteristics of a traditional capital budgeting project is basically you're spending a large sum of money because these are projects that are very expensive and taking a significant portion of your capital budget. These funds are going to be committed permanently, if not for just a very long time period, and they're extremely costly to reverse, so you don't want to make the mistake of making a wrong investment and then trying to back out of it. And these investment decisions are critical because, as I've mentioned before, the success of these projects determine whether or not you are able to meet your most important financial objectives. The key to adding value, the whole idea behind project investment is to add value to the firm, but the key to adding value then is to invest in projects that have values greater than their cost and allow your firm to maintain its competitive advantage. So that sounds very simple, just, it's kind of like calories in, calories out type thing. If you want to lose weight, then you take in fewer calories than you expend. If you want to gain value, then you spend less than you take in. But it's oftentimes easier said than done. Maintaining your competitive advantage means, your competitive advantage is what differentiates you from your competitors. So you always want to try to have some sort of advantage over your competitors that keeps customers coming to you. Some principles of estimating cash flows. I like to go through these because oftentimes if you're not sure how to approach a number and a problem, sometimes if you come back to these principles, it might help you know how to treat the issue. One thing we want to keep in mind is that we are not dealing with accounting profits. We are dealing with cash flows, and they are different because accounting profits include things such as depreciation, for example, which is not a cash outflow, right? Depreciation is just the amount we depreciate. We bring the amount of the assets down in our accounting books each year to show that an asset is deteriorating, but we don't write a check out to depreciation, each year. So cash flows should be considered as opposed to accounting profits, and so you'll see that as we go through the cash flow formats. The other thing to keep in mind is we're always looking at cash flows on an incremental basis, meaning you're asking yourself the question, how much better off am I as a result, or how much better off is the firm as a result of taking on this investment? I have a piece of machinery right now that produces $20,000 a year in cash flows, but I could buy a more modern piece of equipment that would reduce the cost of operating this machinery, and so instead of producing $20,000 a year in cash flows, it would produce $25,000 a year in cash flows. Well, when I'm evaluating this new possible machine, I would evaluate it against a net benefit of $5,000 a year, correct? Because I'm only $5,000 a year better off if I buy this machine. I've already got a machine that's generating $20,000 a year in cash flow. This machine would give me $25,000, so it's only giving me $5,000 more. So we have to evaluate based on the incremental advantage as a result of buying the asset. And then last, cash flow should be considered on an after-tax basis. That's pretty self-explanatory. We'll take out taxes and everything else before we move on. Okay, some additional principles of estimating cash flows. All the indirect effects of a project should be included in the cash flow calculations. An indirect effect is anything that can impact your cash flows that's not just directly related to the project. So it's kind of a catch-all for anything, and it can be very project unique. I'll give you an example of one of the most common indirect effects, and that would be cannibalization. So let's say you're thinking about introducing a new product, and you already have, and even to be more specific, let's say that you own a winery and you're thinking about introducing, making the investment to plant some different types of grapes to introduce a different type of wine. If you do that, you're probably going to cannibalize the sales of some of the other wines that you already offer. And so you would have to try to forecast what that impact would be, what that cannibalization impact would be. And that would have to be included in your cash flow analysis. And so you would have your revenues that you expect to generate from the new wine minus the lost sales that you would have on your other wines of customers that switched over to this new wine. Okay, that's the effect of cannibalization, and then just move on through your cash flows from there. Sunk cost should not be considered. Sunk costs are costs that you've incurred before the project was even being considered. I like to use movies as an example of that. For example, let's say that you pay your $15 to get into a movie, and then your other $30 to get your popcorn and your candy and your soda, and you go into the movie, and 30 minutes into the movie you see that this movie is just a bummer. So my husband and I have this little thing back and forth where he refuses to leave because he's invested all this money into seeing the movie, whereas 30 minutes in I can tell I'm not going to like the movie. I don't want to invest another hour and a half of my time watching a bad movie. So I would consider, or what I have to do is at that 30-minute mark decide, do I want to invest that other hour and a half into the bad movie, or go on and do something else that I would enjoy more? Because I've already paid the money into the movie. I've already purchased the popcorn and the soda and the candy. That's a sunk cost. That shouldn't even be considered as part of the analysis. Either way, that money's gone. There's nothing I can do about it. What I can do, though, is decide from here on out, do I want to waste another hour and a half of my life? So generally the answer for me is no, and I will say, hey, listen, I'm going to shop for a while. Text me when you're out, and I'll come pick you up. And then he can move on with the movie. So same type of thing with a business. We've already invested this money. We're deciding, okay, is it good to continue on with this project? This other money was invested before we were even considering the project. So since it was money that was spent before we were even considering this project, it is a sunk cost. So therefore you don't penalize this project by including that sunk cost in. So you do not want to consider it. And it's a very common error when it comes to capital budgeting projects to include sunk cost when they should not be. Resources should be valued at their opportunity cost, meaning if you have a piece of property that your company bought 10 years ago for $10,000 and now it's worth $50,000 and you're thinking about building a facility on that piece of property, then for the cost of the land you would include it to be $50,000 even though it only cost you $10,000 10 years ago. Because by building the facility on that land, you are foregoing the opportunity to sell that land for $50,000. Before we can start with the actual cash flow estimates, there's some background information you need to know. Sometimes when we're purchasing a new asset, it is to replace an old asset like we talked about before. And if you are replacing an old asset, then there's taxes that are associated with the sale of the old asset. So we need to understand the relationship between depreciation, taxes, and book value. So that's what we'll be doing here for the next few minutes. As I go through the examples, I'm going to use equipment as our primary example only because it's the most complex of all the cash flow calculations. As I mentioned before, if you're dealing with a non-asset type capital budgeting problem, the only difference is you don't have depreciation, and so therefore it simplifies the problem. But since equipment is the most complex of the problems, that's what I'll go ahead and use for my examples as we move forward in this lecture. Okay, before we get into the cash flows, we're going to have some background information we need to know about depreciation, taxes, and book values. So we're going to start out with straight line depreciation, which everyone should be familiar with in your accounting course. But just as a quick review, we find that we can get the annual depreciation by simply taking the installed cost of the asset, which is the installation price, plus shipping, plus installation, plus modifications. So let's see, price, shipping, installation, modifications. Yeah. So any sort of modification you need to get that asset up and running for you is part of that depreciable installed cost, installed base. From that, you subtract an estimated salvage value, and there may or may not be a salvage value. A lot of times that's just zeroed out, but if the problem says there is a salvage value, then you would subtract that from the installed cost. And then you divide that by the estimated economic life of the asset, which would also be given to you in the problem. So to give you an example, we've got a company that's purchasing a machine for $12,000 and has an estimated salvage value of $2,000 at the end of a 5-year economic life. So therefore, to find the annual depreciation, you just take the purchase price of the machine, which is $12,000, subtract from that the $2,000 salvage value of the machine, and divide that by the 5-year economic life. So your depreciation would be $2,000 per year, every year for 5 years. Now here's where we get into the appendix of your book in a chapter, and I like to cover the modified accelerated cost recovery system as a method of depreciation, because truthfully most firms do not use straight line depreciation when they're working with capital investments. They actually use an accelerated depreciation method. There are several different accelerated depreciation methods out there, but this is the easiest one to deal with, and it is commonly used. So your textbook has this one, and we can go through this. The benefit in accelerating your depreciation expense is that the depreciation expense gives you a tax write-off. Right, you get to subtract that from your income before you figure up your taxes. And at the same time, depreciation, like we said before, isn't an expense that you actually write a check for. It's not a cash outflow. It's just again a mark in your accounting books to show that an asset has deteriorated. So why not go ahead and write off as much of that depreciation as we can in the earlier years so that we can get the tax benefits as soon as possible. Now, over the life of the asset, and you see that in the third point there, over the life of the asset, your total depreciation expense is the same, whether you use an accelerated method like Makers or whether you use straight line. It's just that with an accelerated method, you get to depreciate your asset faster. And we know that because of the time value of money, if we can save money in taxes this year as opposed to waiting 5 years from now, then that's a benefit to us. We can take that money this year and invest it and make money. So that's why most firms use an accelerated method. One thing about Makers is it does use a half-year convention, and what that simply means is that regardless of when you actually purchase the asset, it simply assumes that you purchased it mid-year. Okay, so technically that first year when you're showing your depreciation expense, you're really getting a half year's depreciation. And I'll show you that again when we get into the numbers. And the other thing about makers is that it does not consider salvage value, so you don't have to worry about salvage value at all. With makers, there's a table, and that's contained in your textbook as well. And so what would happen is, and whatever asset it is you're evaluating will fit into what we call one of these property classes. So there's a 3-year property class, a 5-year property class, a 7-year property class, and there are ones that go beyond that, but they're for buildings. So we don't usually get into those in this course. But you will be using these that you see here on the screen. You'll be told in the problem what type of asset will fit in which property class. So you won't have to figure that out on your own. In the real world, the IRS does have very strict guidelines as to what type of asset fits in a particular property class, and so you would know which one to use. To kind of give you an example, technological items typically are in a 3-year class, automobiles, trucks, usually a 5-year class, and most of your manufacturing equipment would fit in a 7-year class. And so what you would do is take those percentages and multiply it by the installed cost of the asset to get your depreciation figure each year. Now the one thing you might notice, look at the 3-year column. What you're doing there is you're depreciating the asset over 3 years. I mean, that's what that 3-year recovery period means. But you've got 4 years worth of numbers, right? 33.33%, 44.45%, 14.81, and 7.41. So what it is it's 3 years worth of depreciation, but remember that half-year convention we talked about? So really that 33.33% is a half year's worth of depreciation. Then the 44.45% is a full year. The 14.81% is a full year, and the 7.41% is the other half year. So it's 3 years depreciation spread out over 4 years. In the same way with the 5-year, notice it's 5 years depreciation spread out over 6, and with the 7-year class asset, you would have 7 years depreciation spread out over 8. So we'll go through an example so you can see how those are calculated. Alright, so let's say GE purchases a $9,000 piece of machinery that required an additional $1,000 for shipping and installation. If the asset is depreciated under makers for a 7-year class asset, what are the annual depreciation expenses for this asset? First of all, we have to come up with our depreciable base. In other words, what is it exactly that we can depreciate? And remember, the formula for the depreciable base is the purchase price of the asset plus installation plus shipping plus modifications. Now here we don't have modifications, so it's simply the price plus installation and shipping, which comes to a total depreciable base of $10,000. So now what I'm doing is, since I was told in the problem that it fit in a 7-year class asset, I took my 7-year maker's rates from the previous table I'd shown you, and I'm taking that $10,000 depreciable base, and to get my year 1 depreciation, I'm taking that $10,000 depreciable base on the previous slide and multiplying it by the 14.29%, so that my depreciation that I can claim in year 1 is $1,429. Then my year 2 maker's rate is 24.49%, and again I'm getting that from the 7-year class asset rates for makers. Again, that table's in your appendix and also a couple slides back. So I'm taking that 24.49%, I'm multiplying that by the $10,000 depreciable base. So my depreciation then in year 2 will be $2,449. And I keep doing that until I go through all 8 years of that 7-year depreciable recovery period, and then you'll see there in that right hand column what my annual depreciation would be each year. Okay, so now we're going to go ahead and take a look at book values. So by definition, a book value is defined by being the installed cost of the asset minus its accumulated depreciation. So in other words, it's the amount of depreciation that's left on the asset. It also just happens to be the value of the asset that's shown on the balance sheet. So what is the book value of the asset at the end of year 3? So we have a 3-year-old asset that originally cost, let's say, $100,000 this time, and it's being depreciated using makers for a 7-year class asset. So that means we're going to go to our 7-year class again and pull down those percentages just like we did from the previous slide, only this time we're applying it to a $100,000 asset. And so you take that 14.29% in year 1 for makers, and that's going to give you depreciation of $14,290. So notice there for the book value, I've got the installed cost of the asset of $100,000 minus the $14,290 worth of depreciation in year 1 plus the $24,490 depreciation in year 2 plus the $17,490 worth of depreciation in year 3. And again, I got those 3 figures by simply taking the first 3 years worth of makers from the makers table for a 7-year class asset and multiplying it by the $100,000 installed cost of the asset. So going down to the next line, we can see then that total depreciation comes to $56,270. So for this asset that's 3 years old, more than half of it is depreciated. So the value on our books, okay, the accounting value, the book value of this asset is $43,730. Okay, that's how we would find the book value of an asset. Now the reason this is important is because sometimes when you're buying an asset, you're buying an asset to replace an older asset that you might already have. And if you can sell that older asset, then that gets included in the analysis. But there's going to be tax consequences possibly with the sale of that old asset. And the idea is if you sell the old asset for more than its book value, then you're going to have to pay taxes on the difference between the selling price and the book value. Or if you sell the asset for less than its book value, then you'll get a tax credit. And I'll run through those examples here next so you can see exactly what I'm talking about. But I just want to explain why it is that we're looking at book values. So there's 3 possible cases, if you have a problem where you're selling an old asset along with buying a new one. Okay, there's case 1, which is the easiest, and that's selling an asset at its book value. So I just went ahead and used round numbers here. Let's say we have an asset that has a book value of $50,000 and you have an opportunity to sell the asset for $50,000. So what happens in that case? Alright, well there's not going to be any tax effect because there's no change in wealth for the firm, right? Because all you're doing is you're taking $50,000 from net property, plant, and equipment on your balance sheet and moving it up into cash. Okay, there's been no change in the value of the firm or anything. There's just no no additional revenues. There's no tax effect. So that's case 1. That doesn't happen very often, but if it does, there's no cost. Case 2, what if we sell the asset for less than its book value? The asset has a book value of $50,000. You're able to sell the asset, let's say, for $20,000. So here we're incurring a loss because you can only sell the asset for $20,000. You're incurring a $30,000 loss because on our books doesn't mean that's the market. The book value is not necessarily the market value. On our books, the value of this asset is $50,000. It's just been depreciated down to $50,000. But the market value is really only $20,000. Market value is just what we're able to sell it for. So if we sell it for $20,000, but our books show it's worth $50,000, we're incurring then a $30,000 loss. The good news, I guess, associated with that is we'll get a tax credit on that loss. So if we assume that the tax rate is 40%, and we'll be making that assumption throughout the chapter, I think it's always 40%. So if we assume the tax rate is 40%, then you would multiply that loss by the 40% tax rate, and that would give you what your tax credit would be, the tax credit that you get as a result of incurring that loss. So then really the net proceeds from the sale of the asset would be the $20,000 that you actually received for the asset plus the $12,000 tax credit. So you would end up netting out in that transaction a total of $32,000. Now we're ready to jump into our cash flow components, and there are three cash flow components. There is the net investment, the net operating cash flow, which goes by a couple of different names. Sometimes it's just called the net cash flow, net operating cash flow, net benefits, operating cash flows after taxes, just kind of a variety of names. So, basically it's the net benefits you expect to receive. Then there may or may not be a terminal cash flow. Some problems you'll have a terminal cash flow, some you won't. Generally, if you sell the asset, if you're expected to sell the asset at the end of its life, then you'll have a terminal cash flow. So the net investment just says how much money you have to put up front to, what's the net amount it's going to cost you up front to acquire this asset. Net operating cash flow is what are the net benefits, and the terminal cash flow is there anything you're getting back at the end of the life of the asset. So first we'll look at the format for the net investment, and the format's pretty straightforward. You have the purchase price of the asset plus shipping, installation, and modifications. And I will remind you that it's these first two components, the purchase price plus shipping, installation, and modifications, that make up the depreciable base, right? It is not that bottom line net investment that makes up the depreciable base. That's a common error on the exam, so that's why I wanted to clarify. So it's the sum of those first two items that I have up there. That's the depreciable base. So we move past that and we see if you are selling an old asset, then you would want to subtract any money that you would expect to receive from the sale of the old asset, plus or minus any taxes that are resulting from the sale of the old asset, plus or minus any change in net working capital. Okay, and again, the plus or minus taxes resulting from the sale of the old asset, we just talked about that. If you're selling it for more than book value, then you're going to have to pay taxes. If you're selling it for less than book value, then you'll receive a tax credit. So that's why you have the plus or minus. And then plus or minus any change in net working capital. We haven't talked about that yet, but the change in net working capital, and we'll go through an example of that in just a minute, but the change in net working capital is the change in current assets minus the change in current liabilities that are necessary to support that asset. And you total all that up and you get a total of that gives you your total net investment, so the net amount of money that you have to put up front. There's the net working capital explanation I was kind of talking about. So to arrive at the net working capital, you'd have to be given this information in the problem. Sometimes you're just told there'll be an increase in net working capital of $10,000 or some amount, and then you just would include that. That would be something you'd add to your net investment. But to be more specific, your net working capital is found by taking the change in your current assets minus the change in your current liabilities. So let's think of how net working capital might be impacted by an investment. So let's say that you're thinking about adding a new product to other products you already offer. Well, so if you're going to add a new product, that means then you're going to invest in some machinery that's going to produce this new product. Well, when you invest in this new machinery, you're also going to have to invest in probably new raw materials inventory, right? So you'll have more money invested in inventories than you would before, because you're going to need raw materials inventory to actually produce this product. And then you'll have more goods in process inventory, more likely. And then you'll have more finished goods inventory, because you're going to have to hold a certain level of finished goods to be ready to ship out to your customers. So you're going to have more money tied up in inventory as a result of making this investment. Hopefully, as you sell more of these items, oftentimes when you make sales to customers, it's on credit, it's on account, and so your accounts receivables may increase. And if your accounts receivables increase, then that will mean that you've got more money, again, invested in your accounts receivables than you had before, right? You'll have more money tied up in that accounts receivables. So that would also increase your net working capital. Now, and it's also, and I've got cash in there too, because it's possible maybe because as a bigger firm with more bills to pay and stuff, by adding this new product, you might have to keep a little bit more cash on hand as well. What helps offset this increase in current assets would be an increase in accounts payable. And accounts payable, if you remember from accounting, is money that is owed to your suppliers for inventories that you purchase. So if you're purchasing more raw materials inventory, well, if you're charging that purchase, then your increase in accounts payable will help offset the additional money that you're having to invest in your inventories. And so it's the net difference between those two, in other words, the change in current assets minus the change in current liabilities, that make up your net working capital investment for this particular asset. It is important to understand, what net working capital is and how it's calculated. And we'll go through. We can go through an example of that again in class. I think it's pretty straightforward here, but like I said, a lot of times it's given to you, but not always. Sometimes you might have to actually calculate the net working capital yourself, and you would just take the increases in those current asset accounts, subtract from that the increase in your accounts payable, and then that would give you your net working capital. Next, we want to calculate the net operating cash flows. And so for each year over the life of the project, what you want to do is, again, remember you're getting the incremental difference. So you want to figure out what the increase in revenues are going to be. And it's very possible that the project may not incur an increase in revenues. Instead, it may cause a decrease in expenses. But either way, that will drive a change in your EBDT, earnings before depreciation and taxes. And you may have a project that changes both. Maybe it increases your revenues and decreases your expenses, or increases your revenues and increases your expenses. But again, both of those together, or either one of those, is going to drive a change in your earnings before depreciation and taxes, which from here on out I'm going to refer to as EBDT. Then from that you subtract your depreciation expense, and that leaves you earnings before taxes. From that you have to subtract your taxes, and that leaves you with your earnings after taxes. And then if it's a project where you're expecting to have maybe an increase in sales each year, you may have additional net working capital expenses that are necessary to meet that incremental difference in sales for each year. So in other words, the the net working capital that you may perhaps have in your net investment is there to support the first year of sales. But then if in the second year of sales you're expecting a 10% increase, let's say, for example, in sales, then you would need enough net working capital to support that 10% increase in sales, and you would take that out of your operating cash flows in year one to support your sales in year two. And then we add back in our depreciation expense, which might beg the question, why do we take it out above and then turn right back around and add it in? And we take it out right after EBDT because depreciation is a tax deductible expense. So we have to take it out in order to come up with our taxable earnings. But since depreciation isn't actually a cash outflow, we don't write a check to depreciation in order to cover it. It's just a mark in our accounting books that shows that an asset is deteriorating. So since it's not an actual cash outflow, and cash flow is what we want to get at, that's the bottom line that we want to get to, we add back in that depreciation expense to get our net operating cash flow. And again, we have to go through this calculation for every year for the life of the project. Now, if you have an ongoing project that never ends, like buying out another company, then I can show you in class next time how we handle that. Generally, we'll project those cash flows 10 years out, and then we'll assign a terminal value. Not that you're going to sell it, but just a terminal value that will kind of be the present value of all the future expected cash flows beyond year 10. And the reason we do that is because it's difficult enough to project 10 years out. So you don't want to be projecting 20 years out and so on. So again, I'll show that a piece in class later on. But if you have a project that has a 5-year life, then you would just do these cash flows for 5 years. I would pause the lecture at this point, and I have some application problems that I posted on Sakai, and you could actually do the first two. It's all part of one problem, so treat it as one problem. It's the Briggs and Stratton problem, and they ask you to do a net investment and a net operating cash flow for Briggs and Stratton, and give that a try and see how you do with it. The answers are also posted separately on Sakai, so don't cheat. Work on it on your own first. See if you can get the right answer, and then check that against the answers on Sakai. Next, we have the terminal cash flow, and not all projects will have a terminal cash flow. The terminal cash flow results from the cash flows you expect to receive if you sell the asset after you're done with it. And a lot of times, the plan might be to run the asset until it's not worth anything anymore, and so you're just scrapping it, so the terminal cash flow is zero, or at least the market value of the asset is zero. Other times maybe you can sell it for something, and if you think you might be able to sell it when you're done with it, then there's going to be a market value associated with that asset, and you would put that here in your terminal cash flow. And then again, if the asset is being sold for more than its book value, then you'll have taxes you'll have to pay on the difference, and if it's sold for less than book value, then you'll get a tax credit. Now, one nice thing that we do include in the terminal cash flow is if you had any net working capital investments that you had to make while you were running the project. So in other words, if you did have investments in inventory and accounts receivables to support this project, then we assume that you're eventually going to sell all that inventory, and we assume that you're going to eventually collect all those receivables, and so therefore you'll be able to recapture all that net working capital. Now, in some cases that's not possible. It may be in some cases the product becomes obsolete or it decays or something like that, and so therefore it's not reasonable to recapture your net working capital, or maybe you can just recapture part of it. But generally, unless you have those special circumstances where the product is obsolete, we do assume that you can recapture that net working capital. So all your net working capital investments that you had put into the project earlier would show up then as recaptured in your terminal cash flow. And maybe that's all you have to your terminal cash flow. Maybe you'll scrap the asset and all you have is that recaptured net working capital. One other possible scenario might be that instead of getting money for the asset, maybe it's going to cost you money to get rid of the asset. So you have to come and pay someone to tear it out or uninstall it and dispose of it for you. So it's possible that instead of having an estimated market value of the asset, you could actually have a negative value there, where you're having to pay someone to come in and dispose of the asset for you. And then again, whether or not you have recaptured net working capital would determine whether or not you have a positive or a negative terminal cash flow. Okay, so let's go ahead and go through an example of cash flow estimates. And this is a for-profit example. I thought I'd show one for-profit and not for-profit. So here we have Boston Health System's support project. So let me just read through the problem quickly. We've got Boston Health Systems, BHS, is a holding company made up of 4 nonprofit hospitals and 1 for-profit subsidiary called Support. Support provides services such as food, laundry, and medical waste disposal to the 4 hospitals. Support also has a print shop that provides some of the printing required by hospitals. Susan Shearer, the CEO of Support, has been thinking about the company's printing situation for some time. The equipment used for printing still works well, but they are operationally inefficient. Susan's been looking to replace them and has found an opportunity to invest in a printer that will replace 2 of the firm's older ones. The new printer would cost $970,000 and would require an additional outlay of $30,000 to cover installation and shipping. The new printer would require that the firm increase its net working capital by $20,000. Both of the old machines can be sold. The first can be sold for $100,000, and we're going to assume it has a book value of $95,000. And the second can be sold for $150,000, and we're going to assume it has a book value of $75,000. The original cost of the first machine was $200,000, and the original cost of the second machine was $140,000, and the firm's tax rate is 40%. Okay, 2 things I want to point out here. One is the original cost of the assets is irrelevant information, and I just threw that in there because at one time, because of our tax code, it was relevant information and factored into our analysis, but for years now that has not been the case. So if you happen to be looking at an old proposal where it was relevant at one point, that is no longer the case given our current tax code. The second thing I want to point out is it says the new printer would cost $970,000 and would require an additional outlay of $30,000 for installation and shipping. I want to point out that the sum of those 2 numbers, which comes to an even $1 million, would be your depreciable base. Okay, a common error is to take the net investment and make that the depreciable base. But again, as stated in an earlier slide, it's the sum of those 2 numbers there. So $1 million would make up our depreciable base. Moving on with the problem, the new printer is expected to save Support $225,000 per year and is expected to have a useful life of 12 years. The asset would be depreciated using makers for a 7-year class asset. So let me stop here for a minute and point out that the benefits of this asset isn't that it increases revenues. It does not. But what it does, we can see that it's reducing our expenses by $225,000 per year. So therefore, since it's reducing expenses, it means our EBDT has to go up by $225,000 per year. Also, the second thing I want to point out, as I mentioned before, if we have a project that lasts forever, we forecast for 10 years and then give it a terminal value. Here though, since we know we have a useful life of 12 years and then it stops, we will go ahead and forecast for the entire 12 years. Since that's the life of the asset, even though it's being depreciated using a 7-year class asset. Moving on with the example, the book value of the printer would be 0 at the end of its 12-year life. However, it's estimated that the asset could be sold for $100,000. In addition, $10,000 in net working capital may be recaptured. So even though we had, again stopping with the problem, even though we had a $20,000 initial net working capital investment, up front in the example, for some reason, it doesn't state why in the problem, for some reason we can only claim half of that back at the end. So we'll be able to recapture $10,000. Now we need to compute the relevant cash flows for this proposed project. So let's go ahead and go through that process. So looking at the net investment, we see that we have the cost of the proposed printer of $970,000 plus installation, shipping, and modifications of $30,000. And as we stated before, that is the depreciable base, the sum of those two numbers. Then we have proceeds from the sale of machine number 1 and 2, and you notice I have parentheses around those to denote negative numbers, because ultimately what we're trying to calculate here is the total cash outflow. And since the money that we get from the sale of machine number 1 and 2 represents cash inflow, we subtract that from our total cash outflow to get a net cash outflow. So we receive $100,000, $150,000 from the sale of machines number 1 and 2. Well, as we stated earlier, the book value for machine number 1 was $95,000 and it was $75,000 for machine number 2. So we're going to have taxes on the sale of machine number 1 and number 2 there. And for number 1 it's going to be $2,000, and for number 2 it's going to be $30,000. And on the next slide I'll show you how I arrived at those numbers. And then, as stated in the problem, we just have a change in net working capital of $20,000. So when you sum all that up, we have a net investment of $802,000. So that net investment represents the amount that we have to expect to put up front in order to get this asset up and working for us. Now, how did I arrive at those tax numbers for machine number 1 and number 2? Okay, remember, this is what we look at when we're looking at taxes on the sale of old assets. So we want the selling price minus the book value will give us the gain or the loss. So for asset number 1, it said we can sell it for $100,000 even though the book value was $95,000. So we have a $5,000 gain. And so if you take that $5,000 and multiply it by the 40% tax rate, that means we'll have a $2,000 tax liability, and that's what you see on the previous slide. And then for asset number 2, we've got an asset that's worth $150,000, but its book value is $75,000. So we've got a $75,000 gain because its market value is $150,000. So we take that $75,000 gain and we multiply that by the tax rate, and we get a $30,000 tax liability for asset number 2. And you see that number also on the previous slide. Now we have to come up with the operating cash flows for this project, and support had said that that this new printer would decrease its expenses by $225,000 per year for 12 years. So I kind of ran out of room on this slide, so I couldn't put out all 12 years here. But you'll see that I have an increase then in my EBDT of $225,000 per year for 12 years. Now, right now I'm keeping things simple and I didn't factor in inflation, but obviously, you know, and I'll pile on more reality as we move from one example to the next, but obviously you would have some sort of inflationary expectation built into those numbers, so it may not necessarily be a constant $225,000 every single year. So I have my EBDT of $225,000. From that, I subtract my depreciation each year, and I just got my depreciation by simply taking the $1 million depreciable base and multiplying it by the maker's percentages for each year, and it fit into the 7-year maker's class. So for year 1, you take $1 million times the 14.29% maker's depreciation percentage, and you get $142,900 as your depreciation. In year 2, I take my $1 million and multiply it by the year 2 maker's percentage, which is 24.49%, and you see I get $244,900, and so on every year through year 8. And after year 8, my depreciation then is 0 because the asset is fully depreciated, which is why I can have that one column there that shows my cash flows in years 9, 10, 11, and 12. So please recognize that that cash flow occurs 4 times. It occurs in year 9, again in year 10, again in year 11, and again in year 12. So when you subtract your depreciation, you're left with then your earnings before taxes. So in year 1, we see it's $82,100. In year 2, notice it's a negative number, and that's okay. Just keep the negative there, $19,900 negative. In year 3, $50,100, and so on, all the way across. Apologize for a little bit of background noise. I'm trying to find the quietest place I could go to talk. So the next step is to subtract your taxes, and it's stated in the problem that the tax rate is 40%. So I take 40% of the $82,100 and I get taxes of $32,840. In year 2, note that I'm getting a tax credit since I have a negative earnings before taxes there. So I still take that $19,900 and multiply by 40%, and I get a tax credit of $7,950. Okay, since it's a credit, I put the negative there because we're subtracting a negative number. In other words, it'll make our negative number be smaller once we take into account that tax credit. And then you go on all the way across and multiply by 40% to get your tax liability. And then that leaves us with earnings after taxes. And so for year 1, it's $49,280. Notice for year 2, it's still negative, but it's a smaller negative than what we had before, and so on all the way across. And now we add back in our depreciation. So you see in year 1, up on the second line, we took out $142,900 for depreciation, and we add it back in now at the bottom at year 1, because again, depreciation is not an actual cash outflow. We just took it out in order to figure up our taxable income. And so we add it back in. There's no additional net working capital investments stated in this problem because we're just purchasing a printer and replacing 2 others. So there's no additional net working capital investments, each year. So therefore, we don't have to take that out. And then we can just sum that up to get your operating cash flows each year. So notice my operating cash flows is $192,160 in year 1, $232,950 in year 2, and so on. And again, I do want to point out in year 9 it's $135,000, in year 10 it's $135,000, in year 11 and in year 12 each $135,000. Then this problem did present us with information for terminal cash flow, it said that after 12 years, when we're done with the printer, we could still sell it for $100,000. It has a book value of 0 at that point, so we're going to be taxed on the entire $100,000. So taxes on the sale of that printer is going to be $40,000 of that. And it stated in the problem that we can recapture $10,000 of our net working capital, and so I've added that in there as well. So we have a terminal cash flow of $70,000. So this picture shows us the timeline with all our cash flows attached to that. So these are the cash flows associated with the support printer project. So at time period 0, or today, we could spend a net $802,000, and in return we'd get $192,160 at the end of year 1. We assume end of year cash flows. $232,960 at the end of year 2, and you'll see there's year 3, year 4. Again, because I was running out of room, you'll notice years 5, 6, and 7 had the same cash flow, so I just put it in there. But that $170,720 will occur 3 times. It will occur in year 5, again in year 6, and again in year 7. And then in year 8, we have $152,800 that would occur. And then notice in year 9, we have the $135,000 that occurs in year 9, again in year 10, again in year 11, and if you also notice, it also occurs in year 12, but you also have to include in year 12 the terminal cash flow. And so the terminal cash flow, I went ahead and summed them up together here. So if you take your operating cash flow plus your terminal cash flow, you end up with $205,000. However, sometimes people choose to keep it separated, but you just can't forget about it. I like to just combine it with my last year of cash flows. So in my last year, I would have $205,000. Now, this is a good time to stop the lecture and work through the Indian River Citrus Company case, where you have to go through and do a little bit more. There I've got inflation and all this stuff, so it's a little bit more realistic case where you have to estimate your net investment, your net operating cash flows, and your terminal cash flow. And I also have the solutions for that on Sakai, so please work through the problem first just to make sure that you can do everything correctly and check it against the solutions. And also, if you have any questions, I'll be happy to answer them when I return, or if you want to shoot me an email, I'll answer them as best I can via email. Sometimes working with numbers is hard to answer questions by email, but certainly we can give it a shot. Okay, I did want to work through one more example on a not-for-profit company. So here I've got Ridgeland Community Hospital, and so to work through this example, let's first read it. The managers of Ridgeland Community Hospital are interested in purchasing a new MRI system. The system would cost $1.5 million, and the hospital would have to spend another $1 million for shipping, site preparation, and installation. Because the system would be installed in the hospital, the space to be used has a very low or 0 market value to outsiders, and so there's no opportunity cost that's been assigned to account for the value of the space. The MRI is estimated to generate weekly usage of 40 scans, and each scan would on average cost the hospital $15 in supplies. The site is expected to operate 50 weeks a year, with the remaining 2 weeks devoted to maintenance. The estimated average charge per scan is $500, but 25% of this amount on average is expected to be lost to indigent patients, contractual allowances, and bad debt losses. So here we're getting into an example again where you're doing something a little bit different than we did before. Here you're actually going to have to compute what you expect your revenues to be. And we're going to have some lost revenues because of indigent patients and contractual allowances and bad debt. You're going to have to actually compute your costs, but you have everything here that you need to make those computations. The MRI site would require 2 technicians, resulting in an incremental increase in annual labor cost of $50,000, including fringe benefits. Overhead costs would increase by $10,000 annually if the MRI site is activated. The equipment would require maintenance, which would be contracted at $150,000 per year, payable at the end of each year. The MRI site would be depreciated by straight-line depreciation over a 5-year life. And by the way, I'll just point out, for not-for-profit, since they don't pay taxes, it doesn't benefit them to use an accelerated depreciation method to shield them from taxes, so they tend to just use straight line most of the time. The MRI is expected to be in operation for 5 years, at which time the hospital's master plan calls for a brand new imaging facility. The hospital plans to sell the MRI system at that time for an estimated $750,000 salvage value, net of removal cost. The inflation rate is estimated to average 5% over the period and will apply to both your cost and your revenues, okay, except for depreciation. Depreciation, we never apply inflation to that. That's just automatically incorporated, either a straight line or some other accelerated depreciation method, but we don't inflate depreciation. And we'll assume that the hospital's cost of capital is 10%, which you do not need that information right now, but you will need it for the next class period. So the hospital's cost of capital is 10%. All right, so what's the net investment then? Well, we have the cost of the proposed MRI, which is $1.5 million, and then there's installation, shipping, and modifications, which is another $1 million. So total net investment, $2.5 million. Okay, now this is a case where your net investment and your depreciable base is exactly the same. So if you were to compute a depreciable base, it would be the cost plus installation, shipping, and modifications, which in this case comes to $2.5 million. Okay, so how do we get our operating cash flows? Well, as stated, we have to come up with our own revenues. So you go through the math and you look at the number of scans you can do each year and how much you expect to get for those scans, and that was given in the earlier slide. And you find out that the revenues that you would get in year 1 is $1 million. And then it computed, or it said in the problem that that amount would increase by 5% each year due to inflation. So that's what you see. You see the 5% increase each year for year 5, up to year 5, because after year 5 we have the new imaging facility. I took out my deductions that occur because of indigent patients and contractual allowances and things like that, and in the proportion that was stated in the problem. So $250,000 in year 1, and that also increases by 5% each year. Leaves me net revenues of $750,000 in year 1, increasing by 5% each year. My labor cost was given up front with the new technician at $50,000 a year, and their cost is also expected to increase at 5% each year. Maintenance cost in the first year was stated to be $150,000, increasing at 5%. Supplies was given in year 1 to be $30,000, or actually I think you had to compute that, and then that increases at 5% each year. And then they talk about additional overhead, starts out at $10,000, and then that increases as well by 5% each year. Notice I pointed out the depreciable base in the previous slide, but notice there's no depreciation expense deducted because there's no taxes, and if you don't have taxes, there's no reason to take depreciation expense out of your operating cash flows to get your taxable income, because there is no taxable income. So you'll see the note there, there's no depreciation and no taxes for a nonprofit firm in the cash flows. So you just sum up your numbers there and you've got your operating cash flow. And then you'll notice in year 5 I also included my net salvage value cash flow for the asset, which is $750,000. So my year 5 cash flow is $1,369,908, and that includes both my operating cash flow and my salvage value cash flow. So if you were to look at the timeline for the cash flows for Ridgeland Community Hospital, you see then in time period 0, it requires a $2.5 million investment. And then in return, you would get $510,000 in year 1 in net operating cash flow, $535,500 in year 2, and so on in year 3, 4, 5. And notice in year 5, I again included both my net operating cash flows plus my terminal cash flow for a total of $1,369,908. So this concludes the cash flow estimation portion of the capital budgeting puzzle. And so you'll see that these are the objectives that we've completed so far in the course, and we're actually we're kind of in the middle of doing that last one there, the next one there, being able to conduct investment analysis and providing recommendations on capital investments. That requires a couple more lectures before we actually do that, but we're kind of in the middle of that objective. So everybody have a good few days, and I will see you soon. Thanks for your attention and time.